There's a mistake that destroys more trading accounts than bad strategies, poor indicators, or lack of capital ever could. It's not about technical knowledge or even discipline in the mechanical sense. It's deeper, more elusive. It hides beneath the surface of every decision, shaping the way traders see the market, themselves, and their place in it. This mistake is the silent assassin of trading psychology. The illusion of control, the belief that we can bend randomness to our will, that with enough effort or precision, we can extract certainty from chaos. It's this delusion that leads traders to overtrade, to revenge trade, to chase losses, to force setups where there are none, and to believe that the market owes them something. The market, indifferent and vast, owes no one anything. It doesn't reward intelligence or effort. It rewards alignment with probability and emotional neutrality in the face of uncertainty. Yet, most traders approach it like a battlefield they can conquer, rather than a mirror reflecting their own psychological state. In trading, control is seductive. Every chart, every line, every technical indicator gives the illusion that patterns can be mastered, but the deeper truth is unsettling. What you can control is only yourself, not the market. The mind rejects this truth because it's uncomfortable. It wants certainty, narrative, and cause and effect. It wants to believe that effort guarantees outcome, that if we study hard enough, analyze deeply enough, or trade longer, the market will yield. But that's not how probability works. Markets are systems of collective human behavior, driven by fear, greed, liquidity, and chaos. To demand control over such a system is to demand control over the emotions of millions of participants. Impossible. Yet time and again, traders fight this battle. They stare at screens longer, widen their stop losses, double their position size after a loss, subconsciously, trying to reassert control over what they never controlled to begin with. The irony is that true control in trading comes only when you surrender the illusion of it, when you stop trying to predict and start managing, when you stop trying to be right and start focusing on staying solvent. Great traders don't seek certainty, they seek asymmetry. They know that control is internal, not external. It's not about predicting what the market will do next, but about controlling your response to what it does. It's about defining risk before entering a trade, accepting the loss the moment the position is opened, and living in the mental space where outcome no longer dictates identity. That's the real battlefield, inside the mind, because most traders aren't losing to the market. They're losing to themselves. The illusion of control begins early in every trader's journey. The first winning streak, the first aha moment where a strategy seems invincible, it creates a dangerous feedback loop. The trader believes they've cracked the code, that they've tamed the market's chaos. But as soon as randomness turns against them, as it always will, that sense of mastery collapses. The emotional pain that follows isn't just financial. It's existential. The ego feels attacked. The mind scrambles for control again, and that's where revenge trading begins. The trader takes trades not to follow the plan, but to restore their self-image, to prove to themselves that they are still in control. Every impulsive click becomes a desperate act of psychological defense. The account slowly bleeds out, not from lack of skill, but from the refusal to accept uncertainty as the fundamental condition of trading life. What makes this mistake so devastating is that it disguises itself as strength. Control feels like confidence. It feels productive. A trader managing multiple screens, analyzing every candle, adjusting every indicator, feels powerful. But beneath that surface lies anxiety. The need to control is born from fear. Fear of loss, fear of randomness, fear of being wrong. The market exposes that fear relentlessly. It punishes the ego that clings to certainty and rewards the mind that can remain calm amidst disorder. It's paradoxical. The less you try to control, the more control you actually gain. Because emotional control, not market control, is what determines long-term survival. In the language of behavioral finance, this illusion of control manifests through cognitive biases. The overconfidence bias convinces traders that their skill level is higher than it is. The illusion of knowledge bias makes them believe that more information equals more accuracy, even though beyond a certain point, information only increases noise. The gambler's fallacy tells them that after a string of losses, a win is due. Each of these distortions creates an illusion of pattern and randomness. It makes the unpredictable feel predictable. And in doing so, it slowly dismantles rational decision-making. Traders stop managing probability and start chasing prediction. They confuse control over process with control over outcome. But no amount of analysis or precision can overcome variance. The future is not a puzzle to be solved. It's a probability distribution to be navigated. Think about that difference. The novice trader seeks control through prediction. The professional seeks control through probability management. The novice wants to be right. The professional wants to survive. This shift in perspective is the dividing line between amateurs and professionals. The market doesn't reward intelligence. It rewards discipline under uncertainty. It rewards emotional neutrality. To the market, the most dangerous trader is not the smartest, but the calmest. The one who understands that risk cannot be eliminated, only priced. The one who understands that losing is not failure, but feedback. That each trade is not a test of ego, but a test of process. Philosophically, this mistake is rooted in a deeper human flaw, the mind's inability to accept chaos without narrative. We construct meaning from randomness because the human psyche abhors uncertainty. The need to control outcomes is ancient. In prehistoric times, control meant survival. But in markets, that instinct is poison. Because trading is one of the few human endeavors where effort and outcome are decoupled. You can do everything right and still lose. You can make a terrible decision and still win. That contradiction short-circuits the human brain. It makes traders search for certainty where none exists. It makes them attach moral weight to randomness, believing the market is punishing them or rewarding them, when in truth, it is simply indifferent. To overcome this illusion requires a fundamental reprogramming of the mind. You must stop seeing the market as an opponent and start seeing it as a reflection. Every emotional impulse it triggers, fear, greed, impatience, is information about yourself. Every moment of discomfort is an opportunity to examine the self's attachment to control. Because until you detach from outcome, you will never trade freely. True mastery begins when you no longer need the market to validate you. When a loss doesn't threaten your identity, when a win doesn't inflate your ego, when you can look at a losing trade and say, I followed my plan, therefore it was a good trade, regardless of result. That's the paradoxical nature of control. To gain it, you must first let go of it. This concept isn't new. In Stoic philosophy, control is divided into two domains: what we can control and what we cannot. The market belongs to the latter. Your reactions, your discipline, your adherence to process, these belong to the former. The Stoics taught that peace comes from focusing only on what lies within your control. In trading, that translates directly. You cannot control price, but you can control your position size. You cannot control the next candle, but you can control your stop loss. You cannot control the outcome, but you can control how much that outcome matters to you. Most traders invert this truth. They obsess over what they cannot control and neglect what they can. They try to predict price while ignoring risk. They try to win every trade while ignoring emotional fatigue. The result is chaos, frustration, and eventual collapse. To trade well is to cultivate humility before uncertainty. It is to understand that every trade is a hypothesis, not a declaration. It is to accept that your edge lies not in knowing what will happen, but in knowing how to behave when it happens. The difference between survival and destruction often comes down to how a trader reacts when reality diverges from expectation. The illusion of control makes that divergence unbearable. It makes you take the loss personally. It makes you question your competence, your strategy, your worth. But when you see control for what it truly is, an internal state, not an external one, you begin to experience a kind of liberation. The losses stop being personal. The wins stop being intoxicating. You enter a state of psychological equilibrium where emotion no longer dictates behavior. This equilibrium is rare. Most traders will never find it because they keep looking outward for answers that can only be found inward. They keep switching strategies, indicators, mentors, and systems, believing that if they just find the right one, the chaos will end. But chaos never ends. It's intrinsic to the market. The only thing that can change is how you relate to it. The mature trader learns to live in that chaos, to dance with it, to operate without the need for control. This is not apathy, it's mastery. It's the difference between being reactive and being responsive, between being driven by emotion and guided by principle, between trading for validation and trading for process. The greatest traders of all time, Soros, Livermore, Druckenmiller, understood this intimately. They didn't seek to control the market. They sought to position themselves correctly within its flow. They managed risk so that when the tide turned, they were ready. They knew that being wrong was inevitable, but ruin was optional. Their genius wasn't in prediction, it was in adaptation. And adaptation requires humility, not control. It requires acknowledging that the market is always right, even when it's irrational. Because the market isn't a logic problem, it's a behavioral one. It's the sum total of human emotion expressed in price. And to navigate that landscape, you must first master the terrain of your own mind. Every blown account is not merely a financial loss. It's a psychological story. Behind every margin call is a trader who couldn't surrender control. A trader who fought randomness instead of managing it. Who believed that with just one more trade, one more chart, one more signal, they could force the market to behave. But the market doesn't respond to willpower. It responds to discipline. It responds to structure. It responds to detachment. To the trader who can hold both victory and defeat in equal regard, the market becomes a field of opportunity, not a source of torment. The number one mental mistake that kills trading accounts is not fear or greed. It's the refusal to accept uncertainty. It's the ego's inability to exist without control. It's the desperate need to turn chaos into order, randomness into reason, and probability into certainty. But trading is not about certainty. It never was. It's about living gracefully inside the unknown. It's about executing perfectly in an imperfect world. It's about learning to find peace not in outcomes, but in process. When you finally understand this, when you truly internalize that control in trading is an illusion, you stop fighting the market and start aligning with it. You stop demanding and start listening. You stop reacting and start observing. You stop needing to be right and start needing to be consistent. And in that shift, something profound happens. The anxiety fades, the noise quiets, and trading becomes what it was always meant to be, a mirror through which you understand yourself. Because in the end, the market is not your enemy. It is your teacher. And it will keep teaching you the same lesson, over and over again, until you finally learn to let go.